whether you're 20 years old or you're 60 years old, if you're going to need money in the next, next 6 months to a year, that money really you should have on the sidelines.
Welcome to Rise Up, where we take a look at this week's biggest stories and try to break them down for you so that you know what's happening in the market and you can make informed decisions around your investment portfolio and your financial plan. We know a lot of people are feeling uncertain at this time, and we really want to create trustworthy guidance for you. That's why here at Rise Growth, our mission is to bring you the best information from the best experts in the industry, people who are really helping clients each and every day through these types of volatile conditions. So if you want extra help, I just want to remind you, you can go to wealthion.com/free for a free portfolio review. And I know that our trusted advisors are ready to help you. My name is Terri Kallsen. I'm a certified financial planner. I'm a partner here at Rise Growth. And my co-host, Joe Duran, is not able to make it this week, but I know you heard some great information from him last week. But I do have two great guests with me today. I have Kevin Grimes, the CEO, and also a CFA and a CIO. Kevin Grimes is the CEO of Grimes and Company. And we also have Todd Herman, who's with us, a CFP. He's also an engineer. He has a number of different backgrounds, and he is an expert when it comes to helping our clients make better informed decisions. So Todd and Kevin, welcome.
Thank you, Terri. Great to be here.
Great. So you guys, you know that I always enjoy the holidays, and I'm sure you do too. This is a 3-day holiday weekend coming up. And I was just wondering if you have an idea of, what do you call a Memorial Day cookout that runs out of burgers? Any thoughts on that?
Jeez, I don't know that one, Terri. What do you call a
Well,
Memorial
I
Day
know you
cookout?
guys have every letter behind your name and you're the smartest people in the world, but this would be called a mistake, STEAK, if you run out of burgers. So just keep that one, share that with your kids. Everybody loves a good dad joke, and believe your delivery would be much better than mine since I'm just a mom. So anyways, let's get back into our show. It's been a 6-day rally spurred off by the tariffs pause from China. And, we started to see a big sell-off on Wednesday after the U.S. budget passed by the House, which contained a lot of tax breaks that will add trillions of dollars to the debt. The Dow sold off more than 800 points. But Thursday, we seem to see a bit of a rebound. So both days have been influenced by flexing yields on treasuries. The 30-year treasury is now about just over 5.1% on Thursday, slightly lower than on Wednesday when it reached 5.1%. The yields, of course, benchmarks for consumer loans that could add pressure to mortgages as well as other concerns in the U.S. economy. But Kevin, I know this is an area that you are definitely an expert in, and you have an eager interest to share with our viewers your view on yields and bonds, and why do they matter at this time?
Sure. Thanks, Terri. So just a quick refresher. I know we have plenty of portfolio managers, hedge fund managers that follow this show, but also there's maybe some people that aren't as familiar with bonds. So just a quick refresher that when bond prices go down, yields go up, and vice versa. And so what we've been seeing as of late are prices going down. And so long bonds are very sensitive to inflation and the value of a dollar. If inflation is expected to go higher during a holding period, or if the dollar is expected to substantially decline relative to other currencies during that period, then the fixed rate of return seems too low for these bonds, and you'll see people sell. Yesterday also, to further complicate things, there was a very weak Treasury auction yesterday afternoon. Very few people were interested in buying new Treasuries. Put simply, people are just concerned about the debt and the deficit. This past weekend, Moody's downgraded the nation's credit rating, putting everything back in people's minds. And then looking at the big beautiful tax cuts in the budget, there's a lot of fat there. We're looking at things like no tax on Social Security or tips, um, raising the SALT tax threshold to 40,000 from 10,000. The budget shows little desire to reduce spending, and with a deficit at 6.5%, the size of our nation's entire economy, that's just at levels that just are untenable to many people. I mean, that level alone, the deficit is the same size as the entire national defense budget alone. So there's a lot of concern. It seems there's less and less desire for investors to fund an unsustainable system by buying long-term treasuries. So there's downward pressure on treasury bond prices, and that's raising a lot of eyebrows, including mine. High yield bond prices make me nervous because the situation is even more untenable, increasing the cost to borrow for the government. So the government's paying more and more each time you see yields go higher, and that's just further compounding the issue. So borrowing costs, like you said, across the country, whether it's residential real estate, commercial real estate, credit card debt, corporate expenditures, high bond yields increase the odds of a recession for this reason. It just reduces spending. So this in turn impacts things like stocks and other economically sensitive risk assets.
Yeah, Kevin, I understand the eyebrows raising at this time. I think a lot of our clients are concerned about that. There's this concept of myopic loss aversion when we have this volatility and we focus on the short-term losses. And Todd, I know you're dealing with clients every day on some of these topics. What are you hearing from your clients just recently, and what are you telling them?
Yeah, so it varies, and it's hard to put my thumb on it. The more conservative investors are saying, should we go to cash? The more growth-oriented investors are saying, is now a good buying opportunity? I think with all of these moves up and down, people are just feeling some sort of decision fatigue. And what you said about loss aversion is very powerful. Investors feel the pain of losses roughly 2 to 2.5 times more intensity than the joy of gains. I mean, most of the time when investors are feeling the losses, they just want their advisor to do something. And so a lot of the times, staying in your existing strategy is the right move statistically, but clients say, hey, you should be doing something. You're an expert. So what I always say in my role as a fiduciary and a trusted advisors is I try and guide decisions based on data, not the noise. And right now there's a lot of noise. And so when we do our financial plans, when we do our financial planning meetings for that matter, we stress test people's portfolios and their financial plan. Monte Carlo simulations are thousands of simulations that stress test based off of different market performance rates. So the goal here really isn't to avoid buying the dips, but it's more to test whether or not your plan is resilient.
Yeah, I as a CFP, Todd, a lot of times this is the perfect time to just revisit your financial plan and see if you're on track to still hit your goals, your retirement goals, your college funding goals. And if
Yep.
you are, your advisor can help you, stay where you are or readjust, right? But there's ways to focus on the long term and hitting your goals versus a percentage below the benchmark. But, Kevin, when it comes to benchmarks, this is another area of your expertise. What are you telling clients that are going to retire or are retired or sending a kid to college in the next year or two? I mean, there's got to be some real anxiety there.
Yeah, look, it's the same answer every time for me, right? It all comes down to time horizon. And time horizon is, when do you need your money back? And it doesn't really have a lot to do with your age. It has to do with what's coming up for expenditures, what's the likelihood that you're going to have to tap that portfolio. So whether you're 20 years old or you're 60 years old, if you're going to need money in the next 6 months to a year, that money really you should have on the sidelines. You should be considering high yield money markets, savings accounts, CDs, things like that, where you can easily access. You don't have to worry about market volatility. Volatility is your enemy in the short run. Volatility is your friend in the long run. So anyone that has a longer term time horizon, you're talking younger people in their 401ks people that are never going to outlive their accounts. They should be invested for growth, and then it's everything in between. You have somebody that's thinking about tapping their retirement account sometime in the next couple of years. I mean, you need a balanced portfolio. You need a balanced portfolio that is exposed to different asset classes, so that when there's market volatility or whatever the market's giving you, you always have a place to go, a place to take from out of the account. And an advisor can help you with that, help make those decisions, help you with your allocation. But like Todd was saying, in general, the decisions should be made up front. The decisions should be made up front with what's going on with your time horizon and really what's the big macro backdrop. Right now, the macro backdrop, there's a lot of uncertainty. I don't like seeing some things I'm seeing right now, like where bond yields are. But at the same time, you got to think that the base case is still very safe. And so, sticking with whatever your plan was a week ago, I think makes sense this week too.
Yeah, that's right. Still makes sense. And the other thing I would add, at least for our viewers, to try to limit the exposure to really sensational media at this time, because there will continue to be volatile markets here. And so, watch us every week if you can. Get our viewership, because you can trust this advice. We're not going to recommend anything off plan for you. We want you to hit your goals. So try to limit that exposure if at all possible, at least for the next few weeks. But, let's move on now. We're going to dive into the markets in a few minutes, but let's go to our next big story. And that's the latest on tariffs and starting to see some real concerns in the retail market. We've heard from Target that their estimates are lowered. Certainly Walmart has raised some concern and raised prices. There's increasing consumer costs overall. On the flip side, Amazon says that while prices are changing, they're not seeing changing in spending habits by consumers. This is a lot of information for our viewers to try to sift through. Kevin, what are your thoughts here in terms of economic concerns, and what are you watching?
A lot of that stuff, it is information, but it is noisy too. You have some retailers that they're not seeing any issues with spending. You're seeing others that are passing through some moderate to mild price increases thus far. None of us know what the policies are going to be in another 2 months once we're on the other side of the tariff pause. So, it may seem like a lot of interesting information out there, but really a lot of this is just noise. If you take a big step back, the things that what we're looking at most, I already talked about bond yields. If you see bond yields go much higher from here, it's gonna raise concerns, like we've said, and it'll only exacerbate things. That may or may not happen, but at the end of the day, the big issue would be if there is a higher likelihood of recession. And I can't think of a better indicator to follow if you're worried about recession than credit spreads. And remember, I've talked about this before. I don't want to get too technical, but credit spreads are basically the difference between what a low quality borrower and a high quality borrower are paying for their debt. And when the spreads are tight, then then things are pretty are fine. Probably makes sense to go ahead and take advantage of the higher yield. But when the credit markets start to see, and the credit markets are really smart, the credit markets are looking out a lot further than the stock market is. So when the credit markets start to see whiffs of recession, then you start to see the spreads widen. And we did see that. We saw it right at the onset of the tariffs, and in late April, we started to see it, and that's subsided. So for now, I think the risk of recession is higher, but it's not. It's certainly not the base case, and it's not being priced by the market right now. So for now, we're still in the clear.
Yeah. And Todd, what about those viewers or clients of yours that are drawing down on their portfolio or are in retirement? Rising costs are definitely a real concern for them. What are you telling people at this time that may be fearful they're going to run out of money?
That is number one on most people's list. You kind of segment your clients in three different buckets here. You have the near retirees. They're saying, will I need to delay retirement or reduce my lifestyle? You have retirees saying, should I cut spending, change my withdrawal rates, or move more to cash? And then you have savers that are saying, should I put more into my 401k, or should I buy more groceries? Well, not more groceries, but groceries that are ever increasing in price. To take a step back, rising costs will absolutely erode purchasing power. And when we look at it from a financial planning perspective, small little changes have huge downstream impacts on a financial plan. And to just think about it from a historical perspective, the average inflation rate since 1926 is about 3%. Now, they changed the calculation in 83, so since 83, it's about 2.5. And I'm not even going to mention healthcare. That's well over 5%, which is kind of scary. But when you look at how we plan at a base of 3% for inflation, for expense growth, and from a healthcare perspective, we're at 5.8%. When I take a client through this and stress test it, I will ask them, hey, do you want to look at your plan at 4%, 5%, or maybe 2%, depending on what they're looking to see. And we'll see again, not to mention this twice, how resilient that plan is. But going back to a withdrawal rate, spending down your assets, 4% is a basic rule of thumb, but that's just a straight line average. Sometimes you're going to be well above it. Sometimes you're going to be well below it. Inflation isn't a reason to panic in the short term, but it is absolutely a reason to look at your plan, to potentially adjust, because again, small adjustments have big ramifications. If you reduce your budget by about $250 per month over 10 years, that's about $50,000, assuming a 7% rate of return. And that's a big deal. That's a big deal. So we're seeing a lot of this right now.
Yeah, exactly. And, Todd, you've just shared incredibly helpful information. And so I just want to encourage our viewers again, go to wealthion.com/free. You can actually get a portfolio review and have one of the Grimes and Company wealth management advisors help you through some of these really critical decisions today. But let's get to our third big story, and that is Bitcoin's bounce. And this last week, it hit a new record high, reaching $111,000, with some analysts now suggesting that it could reach $175,000 by year end. And what I find really interesting about this is usually Bitcoin has been paralleling the stock market, but in this case, it looks like it's the inverse. Kevin, could this be a safe haven for viewers?
Well, I think it's funny. We're talking about Bitcoin 2 segments in a row, which is great. It's right up my alley. I don't think you can call Bitcoin a safe haven. At 3 times the volatility of the stock market, it wouldn't be a safe haven. However, it could be a really good place to park long-term assets if you're concerned about the major currencies and treasuries and deficits and national debt, things like that, structural problems for large economies. If these types of concerns increase, it'd probably be good or something to consider putting something into an asset that is decentralized and has a limited supply. So I think that's why you're seeing this. But I think it's interesting that a lot of people think that Bitcoin is you said parallel stocks. I think another word for that would be highly correlated to stocks. And correlated is simply a mathematical term. It's basically how much is one thing's return determinant of another thing. So Bitcoin being determinant of what equities are doing. And it's basically how much do they move together. If something's got a correlation of 1, they move perfectly together. If something's got a correlation of -1, then they're perfectly opposite to each other. If something's got a correlation of 0, then there's no correlation. There's no you can't discern anything. Over time, if you look at Bitcoin, we just did a study from 2020 to 2024. Bitcoin's correlation to stocks is pretty darn low at 0.32. That's I mean, I would say you would want to see scores of like 0.6, 0.7 for it to be relevant. I think what people are thinking is that since the election, Bitcoin moved like all risk assets did. They all moved in tandem. Everything went up in this post-election frenzy. Probably helped that there's a crypto-friendly president that came into the office, and there was a lot of hopes for lots of stimulus, and so everything really went up. And so there's a period of time where they moved in lockstep, but that just hasn't been the case recently. And even when you cited it, I think year to date Bitcoin's up 19%. Is that what it is?
Mm-hmm.
And stocks are slightly negative. On Wednesday, yesterday, Bitcoin was up, I don't know, 1.5%, 2%. Stocks were down 1.5%. So, and even today, Bitcoin, just taking a peek, Bitcoin was up 2.2%. Stocks are, we're up a little bit, up marginally. So, you're seeing that correlation break down. So yeah, maybe there's just Bitcoin's becoming a place to hide if you're concerned about these long-term structural issues.
Yeah, it's a place to hide for sure. But, what does that actually mean, Todd? And when we're talking to clients about their portfolio, what percentage are we recommending? And should it be directly in the portfolio, or should we looking at, crypto ETFs? What are your thoughts?
That's a great question. We just talked a little bit about volatility. I'm going to ask you a question, Terri. Has there ever been a period where Bitcoin hasn't been volatile?
Well,
Yes
this
or
isn't
no?
another Memorial Day joke, is it? Because I promise I'll get it wrong. But no, I don't recall a time when it hasn't been volatile.
I couldn't agree with you more. But if you think about it, what we're doing with clients who are interested in owning Bitcoin is kind of reframing it. So we're telling them it is a high risk, but a controlled satellite position of your portfolio. It has risk parameters, it has rebalancing rules. You cannot manage Bitcoin based on emotion or volatility. And I would love to repeat that, but I'll save some time. My recommendation essentially is to hold about 5%, but it will depend on your time horizon, your liquidity needs, and honestly, your discipline. Emotion is not a rule. But how you own it really depends on how comfortable are you with technology. You can directly own it. The pros of doing that is you go to a brokerage and you will actually hold it in your account, 24/7 trading, pure exposure. The cons is that there are custody risks and there's a lot of fraud still in the industry. If you hold it through your brokerage in a taxable or an IRA, that has much cleaner reporting from a tax perspective, but you can hold an ETF that has a bunch of different coins in it. Cons, though, it has a high expense ratio. So that's something to watch out for. And, as a fiduciary, I emphasize that Bitcoin, it's still speculative. It's not a core, it's speculative. So any allocation should be sized with understanding that it could absolutely go to zero, it could double, it could triple, or it could do nothing. Okay, so for most clients, crypto has a seat at the table, but it's just not the main course.
If I could jump in, I don't think it's going to do nothing. It's going to do something, that's for sure. Just one quick thing. There are several ETFs out there for Bitcoin they have very low expense ratios, and it makes it easy to hold in a brokerage account. You don't have to worry about passcodes and things like that. I think for this reason, where this could be a catalyst for the future, has been so far. In order to have an easy way for advisors to manage Bitcoin for clients. What we like to do here at Grimes and Company, if a client's interested and they engage us to do so, we can advise on how to accumulate Bitcoin. We can help them understand entry points, help people maybe understand when things are getting overheated. Maybe we're starting to get a little overheated right now. We'll see. Could maybe try to understand how far things could go on a sell-off. So we obviously don't have a crystal ball, but we can help people understand how to over time accumulate this asset. But it's a very long-term asset. People should not buy it unless the plan is to hold it for a very long time. people that have held it for a very long time have definitely benefited from it. It's the best performing asset class that there is right now. It has been since it came out, but it definitely, it's something that you need to have the gut check before you do it. So
Yeah, that's great
make sure
advice.
you think it through.
Yeah, Kevin and Todd, you both mentioned emotional investing, right? And trying to take the emotion or the panic out of it, and or herd mentality, right? We hear a lot about herd mentality, that you just follow the herd and you hope for the best. Well, I would recommend that you get an advisor, a fiduciary, to bounce these ideas off of, so that you don't find yourself in this emotional cycle of panic and anxiety. Advisors are really there to help you think through this so you don't make any reactionary decision. So, but let's now get to our viewers and their questions. Our big topic, we promise we would go a little bit more deep into, there's so much concern about bond yields and what it all means. And so our first viewer, Chris from Colorado, is confused. He said, because rising yields are usually a good thing and now they're being seen as concerning, Chris really wants to understand why and how he can tell the difference. Kevin, could you take that one?
Sure. Well, Chris, I would say that high yields represent a really good opportunity for bonds, right? Buying bonds with really high yields, it's like buying stocks with really low valuations, right? It's attractive, and obviously with bonds, high yields, you're taking down that yield. So when you're putting new money to work in a high yield environment, like right now, it probably makes a lot of sense, and you can benefit from nice levels of income. The problem is when you buy bonds and then yields go up while you own them, and during those periods, that means the prices of the bonds have declined to reflect the increase in interest rates. So the most important thing to remember, though, if you're a long-term bond investor, is that if you're holding bonds to maturity, then it really doesn't matter to you. Bonds generally pay income payments or coupon payments twice a year, sometimes 4 times a year. So you own you're going to collect your coupons while you own the bonds, and then when the bonds mature, you're going to get your money back. What happens in the meantime doesn't really matter. So that should make you feel good. That's one of the reasons why people really like fixed income, why they like to put a lot of different bonds together with successive maturities. That's a fixed income ladder, so you always have something coming due. It helps mitigate the risk of interest rates moving, and helps you always have bonds coming due to take advantage of opportunities like right now in the bond market with higher bond yields. So like everything else, it all comes down to time horizon. If your time horizon's long and you can hold that bond to maturity, then none of this really matters.
Yeah, Kevin, do you talk at all about with your clients, credit ratings, debt to equity, trends in earnings or cash flows? Is that ever a consideration?
For bond investing, yeah. For stock investing, definitely. For bond investing, yeah, we're really focused on the likelihood that there's going to be a change in credit rating, right? So if especially if you see a bond go from somewhere in the investment grade space, so a rating above triple B or triple B and above, if you start going below that into the high yield or junk bond category, then you'll see prices decline. So we're always trying to decide where we want to be for certain investors. We do like high yield bonds where it makes sense. We certainly like investment grade bonds. Right now at these levels, high quality corporate bonds with companies that have strong cash flows. I mean, it seems like a great opportunity. Locking in some really attractive yields, especially when you see stock valuations that are high. So all things equal right now, bonds are probably more. I would say they're certainly more attractive in the short run than equities. But yeah, we're looking at all of those metrics and really trying to determine what's the likelihood of default, and hopefully that's very low for what we're invested in, and B, what's the likelihood of a credit rating change, because we want to be on the right side of that.
That's great. Todd, anything you'd like to add from your clients?
Not on this one. I think I agree 100% with Kevin.
Oh, good. Well, that doesn't happen that often. So let's mark this day down. But let's go to our next question then. We've got Shelley in Delaware. It says long-term bonds are supposed to be a safe haven, but are they still? And Todd, I know you get this question a lot. What are you telling your clients?
Yes, so I think it's really important to define what safe haven actually means. If we define safe haven as low credit risk, US Treasury is absolutely among the most secure assets globally. If we define safe as low price volatility, that's not the case. Long term bonds are absolutely vulnerable in rising rates inflationary environments. Like Kevin said at the beginning of the show, bond prices move inversely to interest rates. And more importantly, in this situation, long term bonds are much more sensitive to interest rate moves than short term bonds. This is literally what happened in 2023. This is when we saw a massive decline in the 30-year treasuries. It was just unbelievable to witness from my perspective. And when you're thinking about it from a portfolio construction view, what we like to do is not just load up on long-term bonds, one specific asset class. We like to load up on multiple different durations. So you have a little bit of short term, you have a little bit of core bonds in the middle, you have some long term. So that way you can build a diversified bond portfolio that isn't immune to interest rate risk, but it will absolutely fare better than if you just had one, section of long-term bonds in your portfolio. And I will say, overall, long-term bonds are definitely not broken. They're just sensitive. And I could make a joke, but I'm really not funny.
Well, I dare to disagree on that one. I think you're pretty funny, but we'll save those for you for your barbecue jokes, okay?
Yes.
All right. So let's go to our third question. That's Kyle from Mississippi. He's wondering how rising yields affect portfolio strategy. He has a fear factor that he's sharing with us, and he's running high, and he thinks, he has a question for both Kevin and Todd. So I'd like you to both weigh in here. We want to talk about your portfolio strategy, and then maybe you can talk about how you help your clients manage the fear during this time.
Sure. You want me to jump in first? Okay, I can go first. So Kyle, I like I said earlier, I don't think right now is the time to really do anything different necessarily, except maybe put some new money to work in some of this higher yielding environment. I will say that in an environment, if you are worried about yields going higher still, there's some areas of the markets that could actually do a little bit better. One area that we really like are dividend growth. We like dividend growth stocks. These are companies that have a ton of cash flow. They're increasing their payouts every year. They have a history of increasing their payouts, even in bad markets and recessions. So every year you're making more and more and more from your portfolio, and you have the upside kicker of the stock market, which is going to outperform over time. So that's something to think about, and also credit. I mean, you look at what high yield bonds, credit sensitive bonds have done in the last several years versus even very high quality interest rate sensitive bonds. The lower quality credit bonds have dramatically outperformed, and they have much bigger yields. Even with tighter spreads, there's some big yields to be had, and they've actually had lower volatility in the last couple of years. So high yield bonds have had lower volatility than treasuries, and that's been the case for 5 years now. It's pretty crazy. But until there's really a sign of recession, like I was mentioning earlier, there's still a place for high yield in the portfolio. We manage a strategy, not to talk our book here, but we manage a strategy that does take on a lot of credit exposure when things are calm, and it's done really well. And if rates are going to go higher still, then that's probably a good place to consider for a spot in the portfolio.
And to add to Kevin, I would say my role here is to separate clients' emotion from strategy. All right. That doesn't mean ignoring it and saying you're wrong, you're wrong. It just means putting everything into context. And so what I said recently to a client is since 1980, the S&P has had an average intra-year decline of about 14%. Yet it's finished positive about 70% of the time. So what I like to focus on is, again, we've said it a couple of times in this time horizon, reminding the clients you can point to your cash bucket as your short-term bucket, but if you have goals for 10 years, your portfolio is going to be set up for 10 years or beyond. Plan-based decisions. We'd like to revisit the plan to show how it's built to weather volatility, to test its versatility. Reframing the risk. Again, it's not just about volatility. It's about failing to meet your goals. And sometimes the best strategy is not reacting when the herd's going one way.
That's right. Well, thanks, you guys. I know our viewers really find this helpful, both, technically, but also emotionally. So thank you for sharing that. Now let's move on to what we should be looking forward to next week. And, next week we'll start getting the minutes from the Fed May meeting. Kevin, what are you expecting? Any surprises?
I don't think so. I mean, I feel like the Fed's still on, wait and see mode. That said, there could always be a couple nuggets in there that surprise people or that people find interesting, and maybe there's some comment on tariffs or something. But I don't think so. We're still in BT mode, before tariffs. So we'll see.
I thought
Next week we are getting CPI, which is still I think a little early. I don't know if there's going to be anything interesting there, but it could be. We'll see.
Gosh, Kevin, I'm really glad I read the notes because I thought BT stood for beautiful Terri, but now I know it's,
There's multiple meanings.
Before
BT,
tariff.
all of which are true.
Oh gosh, forget that. All right, but let's talk about the inflation reports that are released next week. Todd, you've talked about clients having fear factor, economic reports, tariff reports. What are you expecting if the numbers are negative or even if they're positive?
That's a really tough question because you've had a set period of time where good news is bad news and bad news is good news. But right now I feel like we're kind of in no man's land. Everyone's focused on the 90-day pauses with the tariffs, and the worst case scenario with that is we go 90 days and no deals are announced. So I'm not surprised if we go sideways from here until whenever the 90-day period is up. But if numbers are negative, you might see some increases, and vice versa. It just depends. We are definitely range bound, in my opinion.
Yeah. And our last story is really about the 3-day weekend, Memorial Day weekend. You guys going to do anything? Got any plans? Barbecuing or exercising, hiking, anything?
Terry, the weather up here in New England right now is pretty bad. We're expecting a lot of rain. But that said, I can report that I'm excited to do not a lot this weekend, which is a rarity.
Well, that's great. I'm sorry the weather's so bad. I won't even tell you where I'll be this weekend, but my daughter goes to the University of Hawaii, so I have to move her out of her, dorm room and be in Hawaii for a 3-day weekend. So it's going to be rough. But Todd, what are you doing?
A whole lot of nothing outside of reading about a 389-page tax bill that just went through. So yeah, in between, playing with my kids and having fun, yeah, I'll be reading.
Well, I really appreciate both of you because you bring such an incredible wealth of knowledge and information to our viewers. But obviously, you spend some of your, weekend time catching up with all of this. So we are grateful that you are not doing anything this weekend. So thank you. But in all reality, I just want to spend a special thank you and recognition of all of our service members that are with us today and all of those who have served in the past. It's a very, very important weekend for all of us as the United States of America. So thank you all. But now we're going to finish up our show. We look forward to seeing you again next week. We have this important mission at Rise Growth, and that's really to help you think through all the things that are happening so you can protect your portfolio as well as grow it. And I'll just encourage you, subscribe to us every week. Come to us with questions, engage with us so that we can help create a peace of mind for you as we go through these next several weeks. Send any questions that you have, and we'll look forward to seeing you at Rise Up again next week. Thank you, Kevin and Todd.
Thank you.
Thank you.